Silver dropped to $87 after Wednesday's trading halt, tested the former resistance zone between 87.20 and 89 as new support, bounced to 90, then failed sharply and fell to 85. It now sits at 86, with the 150-day exponential moving average acting as a confluence level at that same $85 floor. Nothing about that level is guaranteed. It held before, it may hold again. The tape reading setup is there for those watching, though what matters more than any single support zone is the news that broke alongside the drop. Jane Street added 20.6 million shares of the iShares Silver Trust in Q4 2025, making them the largest holder of SLV with a position worth $1.3 billion. They went from 41,100 shares in Q3 to 20.67 million by year-end, leapfrogging BlackRock at 20.5 million and Morgan Stanley at 18.1 million in a single quarter. Understanding what that accumulation actually means requires looking beyond the surface narrative. This has nothing to do with bullish or bearish. This is about control. When the largest quantitative trading firm on earth piles into a silver ETF at that scale, they are not sitting passively waiting for a long-term trend to reward patience. They are positioning to extract edge from every volatility cycle the asset produces. Their edge comes from retail traders reacting emotionally to price swings the firm itself has the capacity to engineer. The documented playbook works in stages. First, they accumulate enough shares to influence price action when needed. Once the majority of traders turn bullish, put options on the underlying asset become cheap because nobody expects a crash during optimism. The firm buys those puts in massive quantities. At a calculated moment, they dump the entire accumulated share position at once. Sudden heavy selling creates a sharp drop. Retail panics. Stop-loss orders trigger across the board. The put options that cost almost nothing now gain hundreds of % in value within hours. The firm then buys back spot at the lower prices, squeezes remaining shorts to push price higher, creates fear of missing the rebound, and repeats the entire cycle from the beginning. Jane Street ran a structurally similar strategy in Indian equity markets. The Securities and Exchange Board of India accused them of using coordinated morning purchases in Bank Nifty constituent stocks to lift the index, while simultaneously building massive short positions in index options. SEBI's 105-page interim order detailed how the firm's trades frequently represented over 20% of market-wide traded value in multiple stocks. The regulator alleged unlawful gains of approximately $567 million tied to manipulation across specific expiry days between January 2023 and March 2025. SEBI temporarily barred all 4 Jane Street entities from Indian securities markets in July 2025 and froze the full amount. The ban was conditionally lifted after the firm deposited the disputed profits into escrow without admitting wrongdoing. As of February 2026, the case remains before India's Securities Appellate Tribunal. Chinese regulators are also reviewing Jane Street's ETF trading behavior following the India probe. The same architecture translates across asset classes. In cryptocurrency markets, the approach is identical. Deploy billions into spot positions, open massive shorts through derivatives, then sell large amounts in minutes using algorithms timed to low liquidity windows. Price crashes. Close the shorts for outsized profit while absorbing a fraction of the loss on spot. Buy back at the new lower price. Engineer the recovery. Open shorts again at the top. The cycle feeds on itself because it feeds on emotions of participants who cannot distinguish engineered volatility from organic movement. Now they hold the largest SLV position at $1.3 billion. A firm with this documented history of volatility extraction across Indian equities, cryptocurrency markets, and now silver did not accumulate that size to wait patiently for the long-term thesis to play out. They accumulated it to control short-term price action and harvest profit from every emotional swing retail traders produce in response to moves the firm has the infrastructure to create. The timing carries its own signal. Around 2020, the SEC and CFTC relaxed several ETF rules governing derivatives use and transparency requirements for large holders. Jane Street's profits surged from that year forward, reaching record levels exceeding $20 billion. Regulators loosen oversight in one jurisdiction. Profits explode. Enforcement actions follow in other jurisdictions years later. The pattern becomes visible only to those who track rule changes alongside profit disclosures rather than watching price charts in isolation. Stop reacting to every candle. Jane Street profits when you are emotional. You profit when you are patient. The macro setup for precious metals remains structurally intact. The real upside unfolds across months and years. You only capture it by surviving the algorithmic chop without getting stopped out at every engineered breakout and manufactured panic dump. Beneath that manipulation sits the data that actually matters. Silver backing futures on COMEX continues to fall, now down to 86.3 million registered ounces. That declining trend has been accelerating, yet new data from the lending markets changes the entire picture. 1-month silver lease rates under normal conditions hover around 0. Slightly positive if the lender wants return, slightly negative if someone has excess inventory. Anything above 0.5% signals stress in the physical market. The average lease rate was 0.04% in 2023, negative 0.18% in 2024. Today it sits at 1.6%. Physical scarcity is now showing up directly in lending markets. When lease rates spike above 1%, market participants are paying significantly more than normal to borrow physical silver for delivery obligations they cannot meet through any other channel. Swap rates tell the deeper story. A silver swap means temporarily exchanging physical metal for cash. Under normal conditions, swaps trade slightly above cash rates because silver owners want compensation. Right now, swap rates are deeply negative at minus 2.8%. Market participants are paying to secure physical silver today while committing to return it a year from now. On paper, that looks like free arbitrage. Buy silver, enter the swap, deliver back in 12 months. The fact that nobody is taking that trade at scale reveals where the stress sits. The market does not trust that physical silver will be easy to source 12 months from now. The problem is not capital. The problem is certainty of delivery. When derivative instruments scream scarcity while spot price consolidates sideways, physical reality is separating from paper pricing in real time. Connect that data to Wednesday's Halt. Volume records show 31,828 contracts traded while the metals market was officially halted. That represents 159 million ounces of silver potentially cash settled while retail traders had zero access to the market. Volume does not print during a genuine halt unless someone is settling contracts off exchange. This is the second major halt in 3 months, both occurring immediately before first notice day of the largest contract months. February gold contracts still show 4,000 open interest, representing 12 tons worth $2 billion that should have settled by now but remain outstanding. The Shanghai Futures Exchange suspended 25 trading groups in February alone for position limit violations. Trading halts, delayed settlements, and exchange enforcement actions clustering around delivery periods are not isolated events. They are symptoms of the same structural problem. Humphrey Neal wrote in Tape Reading and Market Tactics that the House always holds structural advantages the public cannot see until the consequences arrive. A well-timed halt resets momentum precisely when delivery pressure builds beyond what the system can absorb through normal contract rolls. Shanghai reveals the physical reality that Western paper markets work to suppress. Shanghai spot at $97, Shanghai futures at $100, Western spot at $86. That $11 premium persists while Western paper consolidates under algorithmic pressure. When the gap survives multiple failed breakouts and trading halts, it is structural separation between two markets pricing the same commodity under fundamentally different rules. The system halts not because price is too high, but because it moves too fast. Gradual increases can be absorbed. Sudden velocity triggers delivery pressure faster than contracts can be rolled forward. COMEX open interest has fallen to its lowest level on record. When open interest collapses while physical premiums persist and lease rates spike, market participants are exiting paper exposure. Nobody abandons futures for physically backed alternatives unless they doubt counterparty performance when settlement arrives. India just expanded the playing field. On February 26, SEBI authorized $385 billion in actively managed equity mutual funds to allocate up to 35% of their residual portfolios to gold and silver instruments through ETFs and derivatives. In January 2026, Indian retail investors put more money into gold ETFs than equity funds for the first time in the country's modern investment history. Now the institutional side receives the same permission. Central banks continue stacking gold at record pace. When sovereign wealth funds and central banks accumulate physical metal at these levels, while Western paper markets experience trading halts and algorithmic manipulation, the largest pools of capital on Earth are positioning for a reality the spot price chart does not yet reflect. Silver mining stocks reveal what headline prices conceal. Silver is off approximately 27% from its peak near $120, while mining equities have declined only about 6.5%. When miners outperform the underlying commodity during a correction, it produces one of the most structurally bullish signals available. The miners are thriving in this consolidation rather than merely surviving it. $86 today demonstrates more durable strength and character than $120 did in momentum. The 150 EMA holding as support alongside mining resilience tells you that institutional capital managing those companies sees through paper manipulation and is positioning for what the physical market structure indicates. Honesty requires presenting what could delay the thesis. Jane Street controls enough SLV to manipulate short-term action through pump and dump cycles for as long as they choose. The Shanghai premium could narrow if Chinese industrial demand softens through an economic slowdown. COMEX can continue rolling contracts forward into May and July to defer delivery pressure. The March roll alone moved 71 million ounces forward in a single session, relieving immediate strain on the system. Now consider the counterpressure. Lease rates do not spike to 1.6% when markets expect easy supply ahead. Swap rates do not go negative 2.8% when traders feel confident about sourcing physical metal next year. Volume does not print during trading halts unless someone is settling off exchange. Open interest does not collapse to all-time lows when participants trust the paper system. Miners do not outperform the commodity during corrections when they are worried about future demand. Algorithms can manipulate the chop. They cannot manipulate the physical deficit. Banks can run paper games to create volatility. They cannot create new silver supply. Exchanges can halt trading to reset momentum. They cannot reset lease rates or swap rates that are screaming scarcity. They can shake emotional retail traders out of positions. They cannot shake industrial users who need physical delivery for manufacturing. The paper games work until they do not. Understanding which moves matter means recognizing that lease rates and the Shanghai premium reveal physical reality, while $5 swings driven by algorithms reveal only sentiment manipulation. Watch both. Know which one carries the structural signal.